Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
This is episode 1102. Can you believe we have done over 1,100 episodes?
I thought it was in 3.
No, it's 2.
Okay.
It's a lot of episodes.
I don't have enough toes to count this. So.
That's a lot. You can go back and look at the channel. We actually have done that many episodes. Anyway, this is going to be a really good one today. We're going to talk about this. It's a theme we've been talking about that someone made an article.
Okay.
This was in I think, Business Week or something like that. A mild recession could actually be good for the housing market. Now, what we're going to do is we're going to go through the article. We've got 2 really good slides. No, we've actually got 3 really good slides that we'll show you. And then there's a bunch of quotes. And we're going to go through the quotes, and we're going to say whether we agree with the quote or whether we don't agree and why, like our basis, in fact, for those.
This sounds fun.
This sounds fun. Okay.
But we want you to play along. So feel free to leave comments and tell us which you agree with, which you don't, and what your opinion is, because we like engaging with you.
Okay, so here's the first quote from the article. Wall Street firms have eased recession calls recently, but a mild downturn may actually be good for the housing market. So over 75% of all guessers have said no recession. 25% say there's a recession, it'll be a mild one, okay? Would a recession actually be good for housing? Yes or no?
So there is a theory that yes, it would be good for housing because there would be some job losses, so that would take some buyers out of the market. It would make other people nervous about their jobs, and that would take them out of the market, so that would lessen the amount of buyers in the market, so that would be good from that perspective. So we have less buyers chasing the few homes that we have, so maybe less multiple offers and that sort of thing. The other thing that people have talked about is that some of these people maybe might put their house on the market for sale. I'm less convinced of that because everyone has to live somewhere, as I like to say, and people generally have a mortgage that is more favorable than renting a similar home. So I don't think that would increase inventory a sufficient amount to make any difference.
Okay, so yes or no? Would it be good for the housing market?
Mildly, yes.
I say yeah, only because interest rates, the Fed would start dropping rates pretty quickly.
Well, so I disagree with that.
Oh, well, let's talk about that later.
Okay.
Right. So the next quote. A recession would likely push the Fed to ease monetary policy and mortgage rates would fall. Yes or no?
No.
Okay. Why is that? I kind of agree with you.
Okay. So, I mean, emphatically, no. I mean, look, if they drop a quarter point, big whoopee skippy, okay? But no, they're not going to drop them to where everybody out there is going to be doing the happy dance, okay? The Fed was slow to the party to raise interest rates. And the Fed learned its lesson from that. So the Fed is going to watch and wait and not do anything drastic quickly. Look, the Fed was put in the position of raising interest rates like a dozen times in 18 months. They're not going to play the same game going down. They're not going to do that. They're much more concerned with inflation. And they also understand that the economy needs time to have the medicine work, needs time to self-correct. So all of those reasons are reasons why I do not think that the Fed would take drastic action to lower interest rates.
Okay, I agree. Next chart. This is the housing affordability chart. As you can see, this is pretty much the lowest affordability's been in recent memory. Now, a lot of this is strictly based on interest rates. If you look at this chart, when its high, interest rates were relatively low or home prices were low. So back in like 12 and 13, home prices were low. And then in 20, it spiked because interest rates were low. Now remember, I disagree with this index for one important thing. This index is only representative of you buying a house 100% loan to value. If you're paying cash, you can ignore this chart completely. It's bullshit. It doesn't mean anything. The affordability is, there is no affordability if you can pay cash. It's just how much you're paying. It's a price, not affordability. This affordability is strictly price versus mortgage rates and full leverage of the thing. As you put more money down, it changes, which is why I think there are people looking at this going, how, they scratch their head and go, how can somebody buy a house when affordability is the lowest it possibly is? And then we see people making offers on, $1.7 million houses.
Right. So affordability, yes, it's an issue at the very bottom, but the rest of the housing market really is not that dramatically affected by affordability, right? Because people are putting, 10, 20, 30% down. People are paying cash. So the affordability, the higher you go in the price point, the less affordability becomes an issue. The main place where affordability plays out is in that bottom of the market, those people that are doing the FHA loans with 3% down and that sort of thing. But for the rest of the market, that's really not an issue.
Okay, the next thing that came up, I was reading the article, I saw this and laughed. It's first thing I thought was loser Fed policy. Like the loser Fed has completely screwed everything up. And then I realized it's looser, a looser Fed policy. Okay, so here's the theory. Federal Reserve's aggressive policy. Tightening campaign has kept many homebuyers sidelined with 11 interest rates hikes in the last 18 months. This is the fastest ever that the Fed has raised interest rates, the fastest and highest, with the exception of Paul Volcker, who did a 4% raise because inflation was like, 13% or something stupid, right? And that was, I don't think you were here yet. Or were you here? You just gotten here.
I was.
83, I think it was 83.
But I was a kid.
You were a child. Okay. All right. In a mild recession scenario, however, central bankers would likely start moving in reverse with rate cuts, which could lead to lower mortgage rates and more affordable homes. So let's talk about this. We talked on the one side of this myth. It's a myth that as soon as the job losses happen in the recession, the houses flood the market because everyone has to force to sell, right? They're going to give up that 2.5% mortgage rate and their $1,100 payment.
Okay. So let's kind of maybe get off the 2.5% mortgage rate for a moment.
Okay.
And consider this, the mortgage payment. Okay. So if your mortgage payment is $1,200 a month and it would cost you $1,600 a month to rent a dumpy apartment versus your nice house for $1,200 a month that you can live in and it's your house, then I'm guessing that you're probably going to stay in your house. You're probably not going to sell it. So that's something to keep in mind. It's not just about the interest rate. It is about that payment. That payment makes a big difference to people.
Okay. Next quote. To be sure, home buying demand could increase if the Fed cut rates so swiftly that mortgage rates see a rapid decline. A flood of home buyers looking to capitalize on lower rates could end up keeping prices elevated. So in one theory, a bunch of houses, like in theory, come on the market because people are panic or sell or whatever. And then the Fed goes, oh my gosh, the economy's starting to tank. Let's drop interest rates really fast. The 10-year falls, mortgage rates dropped, and people go, oh, look, mortgage rates have dropped. Let's rush out there and buy a house before they go back up, which is the counter argument to that. What do you think about that?
Well, I think that it's a valid counter argument from the perspective of if mortgage rates were to drop precipitously in that way, yes, people would jump in the market, people would overbid like crazy because they understand this is just an aberration and the Fed will wake up and change its mind again. But I don't see that happening. Like I said, I don't see a scenario under which this Fed board would lower interest rates quickly and substantially that would cause that sort of panic buying again. They learned their lesson before. They don't want to do that. They don't want to have so much money moving around the economy again. It's harder for them to manage the economy with so much money moving around too. That's something to keep in mind.
Okay, here is a chart. This is the last 6 recessions, the actual recessions that were actually called a recession. This does not include the 2022 recession because it was waived off as on a holding penalty. Okay, 1980, 81, 2001, 2020. We all had recessions. 2020 was actually a pretty deep recession, 17% unemployment or something.
Okay, but 2020, I want to say that I want to wave that one off. And
why do you want to wave it off?
Okay, so I want
illegal block to the back?
Something like, exactly, basically. Yeah.
Face masking.
Well, I want to wave that one off because it was a government-created recession.
Okay.
And
fake lockdowns. We need to lock down.
And it was a government-mitigated recession. And what I mean by that is the government paid people money, so the unemployment was, while it was substantial, people got money.
Right.
The second part is that there were all the eviction moratoriums. There were all the moratoriums against anything even remotely derogatory against anybody who didn't make their mortgage payment. So while that was a recession from the perspective that, yes, we had negative growth, the impact on individuals was not that you would expect when you had 17% unemployment.
Right.
People didn't lose their homes. People were not evicted. People did not suffer the extent of negative consequences that you would expect for people who are unemployed. So while, yes, it was a recession, the effects on people were not commensurate with what you would expect in that circumstance.
Okay, here's the next quote. In a recession, some Americans would lose their jobs as unemployment rises, which could lead many to sell their homes or face foreclosures. More availability for house hunters could bring list prices down and minimize bidding wars. I'm going to put a big false on this. One, imagine this. You find out there's a recession, your employer lays you off. Mm-hmm. You stop making your mortgage payment. How long does it take for the foreclosure to happen?
So it's going to take three things. First of all, it's going to take years for the foreclosure to happen. 2, you're going to reach out to your lender, your servicer, and explain what's going on and have a workout plan because they do want to work things out with you. 3, you will find another job. Okay, people find jobs. I understand that there won't be as many available jobs, and maybe you won't find your dream job again right away or anything like that. And I understand all that, but you will find a job. You will find a job that puts food on the table, and things might not be great for a while, but things will work out. The other thing to consider is, even in the most robust economy, the economy where we've got full employment, guess what? People are unemployed. People lose their jobs. Jobs are outsourced. Jobs just no longer exist because that position has been eliminated. Whatever it is. So in any kind of economy, there is job churn. So that must be considered as well. The idea that just because somebody loses their job, all of a sudden everything around them turns to ash is not reasonable. People are more resourceful than that, particularly people who understand how the system works and they understand that, hey, if you've lost your job, you contact your servicer, you work something out, you go find another job. Maybe it's not your dream job, maybe it doesn't pay as well as your previous job, but you get a job, and then while you're working, you find maybe the job that you really want, and it'll all work out. People are resourceful. They are not that rigid.
We literally know more about foreclosures than probably anybody. It was a business we did for a decade. We listed foreclosure homes from the bank. We understand the process, and we manage the process for the banks here in Las Vegas. We've listed thousands and sold thousands of foreclosure homes. We knew people that didn't make their mortgage payment we went out to dinner with somebody who didn't make their mortgage payment 4 years. Right. And they were just literally like, oh, well, we're just going to stay until they throw us out, but we're living for free and we're saving all this money.
Right. So here's what I want you to look at. If you think that foreclosures are coming, I'm not going to argue against you, but what I am going to say is, what comes before foreclosures? Maybe short sales? How many short sales are out there in the market? Where are you watching from? And tell us how many short sales you're seeing. Because without short sales, you can't have foreclosures.
Yeah, and you have to have 90-day lates. Right now, we have the lowest ever. Okay, here's the next quote. It's worth noting, too, that homeowners today are more financially resilient than in 2008, a time when anyone could secure a mortgage. This could help buoy home values enough to prevent a dramatic crash. Juana, how is this much different than... People keep bringing up 2008, saying it's exactly, like they're exactly the same, like they're exactly matched. So let's just talk about how much equity people have in their houses now versus then, and the type of loans that they were given.
Okay, so we'll start with the type of loans because I think that's where we start, right? So the type of loans. Back in 2008, people had variable rate mortgages. People were not well qualified as far as what it took to get a mortgage. They had stated income. They had all kinds of exotic loans that really did not require people to prove that they were going to be able to meet their debt obligation. Today, people have to meet their debt obligation. Then the average credit score was something like in the mid 600s. Today, the average credit score is in the mid 700s. Today, people have to prove that they've got reserves, that they've got good credit. They have put a lot of money down. So it's completely different as far as the lending practice is concerned. Okay.
What about how much money were putting people down? They putting down now versus then?
Okay, so then they were putting, not only were they putting zero down, sometimes they were getting loans over the value of the house. So let me give you an example. There were lots of lenders, but probably the most famous one was Ditech. So what they did is they would give you a 125% loan. So that means that if your house was worth $100,000, they would loan you $125,000. So people were upside down to begin with. Today, that doesn't happen. Today, it's the reverse. They will loan you up to 80% loan to value. So you have to put 20% down. So there's a lot of that going on. That's not to say that there are not 10% down loans out there, or FHA loans with 3.5% down. Yes, they are. But most borrowers are putting about 20% down. Back then, we didn't have the amount of cash purchasers that we have today. Like in Las Vegas, more than half of the homes are free and clear. Nationally, more than 40% of the homes are free and clear.
42%.
And nationally, again, more than 30% of homes currently are being purchased cash. So there's a lot of cash in the system, which supports property values. We didn't have that back then. So that's another consideration.
I think that's the number one reason when people see interest rates going up and they said home prices would crash 40 to 50%, and then it didn't happen. They went, I don't understand. Every single person in the country has to get 100% loan for the house, and the only way they can afford it is by paying as much as they possibly can out of their, how much they get in income, when that's really not the case. Like, people have this false belief. It's not, guys, it's not, 1974.
Okay, so here's the thing. I think, the people who are putting that information out there, I think one of two things. Either they're disingenuous.
I was going to say dumbasses, but disingenuous.
I like disingenuous better.
Okay, they're disingenuous.
Or they simply are not financially literate.
Ignorant. They're dumbasses or they're ignorant.
So I think those are the two things.
You're the Romanian.
Yes.
Do you know how to say those words in Romanian?
I don't. I actually have a very clean vocabulary.
Right. Okay. Okay. Now you're probably saying, because the thing everyone's been hanging on to is the recession and the job losses and people out of cash, right? So this chart here, this shows the amount of household liquidity in the U.S. in trillions of dollars. Now you can see we were bumping around at about $1 trillion of household liquidity till the pandemic hit. And then it spiked up. We have about $4.5 trillion. We have more household liquidity. This is just cash and checkable deposits than we have ever had.
Okay, and before you say that that's all false home equity, I disagree.
It's not equity.
That's what I'm saying.
It's liquidity.
It's liquidity. So why do people have so much money? Well, let's start with the fact that we went through, about 2 years of living in our pajamas and not traveling, not going out to dinner, not going out to do things. We bought out Amazon the first 2 months, and then there was no place left to put stuff.
No toilet paper at Costco.
So people really didn't spend. People did invest, though. There was a lot of, Robinhood. There was a lot of investing going on. I grant you that some people lost money, some people made money, but clearly, looking at these numbers, more people made money. Okay, so people are in better financial shape now than they've ever been. And if you're not one of them, I am very sorry for you. But you don't represent everybody, right? And I'm not suggesting that this chart represents everybody, but I am suggesting that there is more money in the system than there's ever been. And that's how we got to inflation. That's how we got to 7% interest rates. This gives you a very clear idea as to why the Fed has become so hawkish about monetary policy and why they are going to be very slow in doing anything that could in any way fuel inflation again, because they know that money is sitting out there and it's going to be chasing goods, and they do not want that, because inflation hurts everybody, but honestly, inflation hurts the poor the most, because the poor have the least amount of flexible spending. And so anytime that goods and services become more expensive, they get hit the hardest. So while we understand that the Fed is generally made up of people who are well-heeled, we also understand that they are very keenly aware of who inflation hurts the most, and they do not want inflation to spike. We also have an election year coming up next year, so they certainly want to keep inflation under control. They don't want to do anything that's going to rock the boat and in any way be perceived as influencing the election one way or another.
If you are poor, your only hedge against inflation is earning more income,
right,
which you cannot control. If you are an asset holder, meaning you own equities, which means stocks, or you own real estate assets, you have a hedge against inflation. Those tend to inflate with inflation. So you're not as reliant on
income.
Yeah, on income. And then also too, if you're collecting rents from properties, not only the properties going up in value, but you're raising rents. So you're making up for the lost in buying power by collecting more money in rent. So you're sort of rising with the tide while everybody else is drowning.
Right. The other thing to bring up is the other people that are hurt by inflation are people on fixed incomes, which those tend to be retirees. And retirees, guess what? They vote. They're probably the single biggest voting bloc. They're the most likely to vote. And so they certainly do not want inflation to eat away at their retirement. And so again, so these are all people that the Fed thinks about, and maybe for different reasons, but they certainly keep that in mind. And inflation is the number one enemy, so to speak, of the Fed, their number one concern. And that's what they're going to do, is they're going to do whatever it takes to keep inflation under control. And, Chairman Powell has said this repeatedly, that even if it means putting the economy through a recession, he's okay with that so long as he's got inflation under control. Because recessions we can get out of a lot easier than inflation. And if you're looking at economies around the world, you'll know exactly what I'm talking about, because recessions come and go. But inflation, particularly runaway inflation, is something that have toppled. They've toppled governments. They've toppled countries. So that's something that the Fed is very, very aware of, and will do whatever it takes to keep inflation under control.
Okay, last quote from the article. But avoiding a recession entirely would likely keep home demand strong and inventory tight, meaning the market stays unaffordable. This is my prediction. I do not predict. I see no signs of a extremely terrible recession, anything bad happening. We could have a mild recession, or we have no recession. I think those are the 95% chance. It's like right. A 70 to 75% chance of no recession, and then maybe a 25% chance of a very minor one. Neither one of those can have zero impact on the housing market. Like Wanda said, you lose your job today, even if you say, forget it, I don't want to make my house payment. You probably still have $150,000 of equity in your house. You're not just going to walk. You're going to do what you can to protect it. Call the bank, say, hey, look, I lost my job. Can I get another one and make payments in a couple months? We just showed you the chart. Mm-hmm. People have $4.5 trillion. All these people that have been making these $1,200 a month mortgage payments are stashing cash in their bank. They trust me. They will be able to make payments. The other thing too is two-income families. One person loses their job, the other person just makes the house payment. No one is going to get rid of that house payment. If there was a recession, it would do zip. It would do nothing. The only thing it could possibly do is help housing by scaring the Fed enough to drop interest rates a little, make mortgage rates go down, and then have a flood more buyers come in.
Well, I think what would actually happen, it's an interesting thought, is so let's say that the Fed lowered interest rates by a quarter point. I think there's a possibility that there would be an outsized effect on mortgage rates.
You mean a reactionary? They're yes. Anticipating future.
Exactly.
Okay.
Exactly. So I think they might lower interest rates a quarter point, but you might see a half point drop in mortgage rates.
Sure.
I think that's a possibility, because we've seen that on the reverse side, right? Right. We've seen that play out. But regardless, half a point, quarter point, that's not the make or break, right? I mean, people who are going to buy a house are going to buy a house. People who are not, they're not, okay? The half a point isn't going to do it. And the people that are waiting for 3%, you're going to have a long wait. People who understand that we all need to live somewhere and we may as well pick the house that we want and have control over the roof over our heads, those people are going to buy homes. That's just the way it is.
I've been making videos. We've been making videos since about 2009, big at the bottom of the market. And we've heard about the all the different ways it's going to crash over the last 12 years, 14 years, and they've all been wrong. They've been wrong every time, and we've been right every time. And we've been right every time. If you don't believe us, go back and watch some of our videos from 2013. The shadow inventory, remember those? The shadow inventory is going to crash the housing market. There was a flood of foreclosures were going to come back on the market. The second wave of foreclosures, and never happened. So
look, as far as being right, it's more like just using common sense, guys. I mean, if you're on this channel, then you're a common sense person who looks at the data and says, okay, well, what makes sense? And that's what we do. We just talk about things that make sense, and that's why you're here. So if you like the video, if it made sense to you, leave us some comments. We like engaging with you. Please remember to like the video, share the video, subscribe, hit the notification bell so you get another awesome video, and we'll see you on the next video. Bye.
Bye.